Good afternoon, everyone. We're going to give all of our attendees just about a minute to get signed on, and then we'll get started. All right. Well, good afternoon, everyone. I am Danielle Casey. I'm the president and CEO here with Albuquerque Economic Development, welcoming you to another fun-filled and jam-packed AED-produced webinar. So, but in all honesty, we have a tremendous program, and this is extremely important information that a lot of folks haven't even been aware of yet. So we're gonna uncover a lot of great details today, hopefully beneficial to either you as business leaders or to clients or others you're working with. So a little bit of housekeeping for today. We are recording this webinar. So if after the program you want to go back and look up some information you didn't see or quite hear right, we're going to post it online on our website afterwards and also share it in our e-newsletters in the future. So no worries if you missed something, or if you know someone who really should have watched it but couldn't quite make it, we will make that available in the future. We're going to save some time at the end for questions and answers. I do encourage everyone, if you have a question for our speaker, please put it in the Q&A so we can be sure to delineate that that's a question. And if you have any chat comments, any information you want to share, or just encouraging comments, feel free to throw that in the chat as well for the panelists or for any of your fellow attendees. So with that, why are we here today? Well, we've had some recent challenges or changes. Gosh, there's a thing. If I start talking about our tax structure, I don't want to start off with that. There have been recent changes to New Mexico's tax structure that do affect business, and there's actually some exciting positive outcomes that we're going to talk about today. And to do that, we've got Marcus Mims with CLA, Clifton, Larson, Allen. He's going to provide some really great overviews and details on these changes. First off, what he's going to address are changes to the GRT, the gross receipts tax, which changes the sourcing rules that took effect actually July 1 of 2021. This means the GRT rate going forward is going to be determined at point of delivery, not point of sale, as has been previously the case. He's going to elaborate on all of that. And secondly, really exciting news, New Mexico will no longer be taxing the lease or purchase of qualified manufacturing equipment beginning January of 2022, which we all know, as soon as the holidays are over, is right around the corner. Marcus is going to help everybody understand what is needed for your business to benefit from this change. And then finally, the CRS-1 form has now been broken out into 3 different forms for GRT reporting, compensating tax and withholding tax reporting. So you're going to learn a little bit more about how to easily navigate these changes and what that form is to begin with. So again, if you have questions, put them in the Q&A. Deborah Inman, our wonderful, amazing leader here on the business development team and a technical expert herself, is going to facilitate the Q&A session when we get there. So with that, I get the awesome opportunity to now introduce Marcus. He is a state and local tax principal in CLA's Albuquerque office with more than 30 years of public and private experience. Before joining Clifton, Larson, Allen, he worked for a Big Four and a national accounting firm where he served as both firms' New Mexico state and local tax practice leader. He's developed technical expertise and experience with multi-state tax. He also worked in industries for several healthcare entities and in state government. So you name it, he's seen it. He has a bachelor's degree in accounting from New Mexico State, and he's a certified public accountant. And he's also extremely active in the community, which of course we love. He's currently a board member of the Albuquerque Community Foundation, Economic Forum, New Mexico First, and the New Mexico Tax Research Institute. He's served on many other boards, for example, UNM Anderson School Foundation, the National Atomic Museum Foundation, and Meals on Wheels. Finally, he's also a member of the American Institute of Certified Public Accountants and the New Mexico Society of Certified Public Accountants. I can't imagine anyone more qualified to be with us today to help us and get us some knowledge. So with that, Marcus, I'm going to hand it over to you.
Thank you, Danielle. I appreciate it. I want to start off first by thanking AED for inviting me to present this afternoon and allowing me to speak. Starting off, welcome. I hope that we're going to talk a little bit about the changes in New Mexico gross receipts tax law. Hope there's some things that you all can get out of it, and I want to say welcome to the presentation. A little bit about you heard about myself, but a little bit about my firm. As you heard, that I am with CLA. We are a national or a professional services firm with 3 distinct lines of businesses. We have wealth advisory, outsourcing, audit, tax, and consulting, and we have offices across the country with a significant presence here in Albuquerque. So more than happy to help and talk to you about your service needs. As Danielle mentioned before, we're going to talk a little bit about gross receipts tax, and the first topic we're going to talk a little bit about is focused on the New Mexico gross receipts tax sourcing rules, and that change was really made a couple of years ago, but really became effective June 1st, 2021. But before we dive into that discussion, I think it's important to talk about or discuss how we got there. Some of you may be aware that back in June 2018, the Supreme Court made probably its most significant state and local tax ruling, or at least on the sales tax side, the sales tax ruling in probably several decades. And basically, it was a court case in Wayfair versus South Dakota. It's important to understand, prior to that ruling, in order for you to have a filing obligation as a business for sales tax purpose in a state, you had to have physical presence in that state. And when we talk about physical presence, we're talking about, do you have an office in that state? Do you have employees? Do you have property? And so that concept, or that threshold, if you will, was established by the Supreme Court back in the 1960s with the Supreme Court's decision in National Bellows Hess, and again reaffirmed with Quill versus the state of North Dakota in 1992. And so since then, the Supreme Court and states have always held that you have to have physical presence in order to be compelled to file a sales tax return in a state. Fast forward to 2018, the Supreme Court in Wayfair versus South Dakota reversed those decisions, and because of its recognition or acknowledgement, if you will, that the economy has changed, many businesses now are able to operate in a multi-state environment without having a presence in many states. The economy has gone to more of a service-based or internet-based economy. And so the Supreme Court recognized that the physical presence test that they had established years prior was probably no longer relevant, and therefore they allowed South Dakota's quote unquote economic nexus test. And what South Dakota established was that if you had a certain level of sales, and in South Dakota's case, it was $100,000, or you had a certain number of transactions in South Dakota's case, it was 200 transactions. That was enough for South Dakota to compel you to file a sales tax return. Well, obviously, by the way I'm framing it, South Dakota won that case. And so what you had after that was you had those states that had sales tax structures in a race to establish their own sort of economic nexus regimes. And New Mexico was no different. New Mexico, in 2019, the New Mexico legislature made significant changes to New Mexico's tax system. It wasn't just focused on gross receipts, but gross receipts was part of that change. And it was probably some of the most significant legislation that we've seen in quite a while, because it was fairly comprehensive and it hit many tax programs. Some of the more notable items that are more relevant to this particular subject area is the fact that New Mexico established its own economic nexus threshold. And so what that meant was that out-of-state businesses that had no physical presence in the state would now be required to have to file a New Mexico gross receipts tax return if they had more than $100,000 of sales in New Mexico, if they had more than $100,000 of sales in New Mexico, they would then be required to collect tax. So this was focused on, the folks like Amazon and, a lot of the big internet companies. But as you can imagine, that wasn't, there are a lot of other companies that make more than $100,000 of sales into New Mexico with no physical presence. They would get caught up in this regime as well. And so that was a significant change. Another significant change was that prior to this legislation, if a business was performing services outside of New Mexico, physically performing those services outside of New Mexico for a New Mexico customer, that the receipts from those services weren't taxable. They were exempt from the gross receipts tax. With this change, those receipts are now subject to gross receipts tax. And that's also a significant change, because as you can imagine, we have a number of service providers. They provide services. They never set foot in New Mexico. Those services are now subject to gross receipts tax. Compensating tax. So compensating tax is New Mexico's version of use tax. So you have the gross receipts tax, which is New Mexico's version of sales tax, but we also have the compensating tax. And so if a seller does not charge a customer gross receipts tax, that customer, if it's a business, is required to self-assess compensating tax. Well, prior to this change in legislation, the compensating tax rate was only 5 1/8%, whereas the gross receipts tax rate could be as high as 8.5% or what have you. So there was a clear difference between what one would pay for gross receipts tax purposes versus what one would pay for compensating tax purposes. Because of that legislation, the compensating tax now includes a local option tax, and so the compensating tax is the same as the gross receipts tax. The other change is that the compensating tax now applies to services. Prior to the change, the compensating tax only applied to the purchase of tangible personal property. It did not apply to services. So in that case where we were talking about where the services were, prior to this change, the services performed outside of New Mexico were not subject to tax. If a service provider didn't charge a New Mexico customer tax, that New Mexico customer prior to this law change was not obligated to self-assess compensating tax. Now they are. So that puts everyone sort of on an even playing field, if you will. And finally, the most significant change that's sort of relevant to this particular discussion, as Danielle mentioned, is the change in sourcing rules, which we're going to start talking about in a few minutes. And that change is allowed New Mexico to go from an origin-based sourcing to a destination-based sourcing. And we'll talk really about what really that means and why that's important. So when we talk about sourcing rules, really what we're really referring to is what rate does the seller pay? In other words, does the seller pay based on where their business location is, or does the seller pay gross receipts tax based on where their customer is? So prior to July 1st, the gross receipts tax was origin-based. And so a seller would pay gross receipts tax based on the location of their office or their business location. Now, with the law change, the gross receipts tax is now destination-based. So sellers pay gross receipts tax based on the location of their customer or where the service is delivered. And this includes a few exceptions. And as you know, this is New Mexico, and so we don't make anything easy. So you'll see how the legislature made it probably, in my view, a little bit more complicated than it needs to be. But we did, for all intents and purposes, go from an origin-based tax to a destination-based tax. The other significant I might mention is the fact that this now puts New Mexico sort of consistent with most of the other states. If you look at how other states that have a sales tax, what their sourcing rules look like, most of the states are destination-based sourcing, and there's probably only a handful of states that are origin-based sourcing, and New Mexico was one of them up until July 1st. And so this makes us a little bit more consistent with the other states. So as I mentioned before, the rules are a little bit complicated for a person that's not used to kind of dealing with these issues. The new rules make a distinction between the sale of property and the sale of services. And so for a seller of tangible personal property, or leasing a property or licensing of tangible personal property, the seller would collect gross receipts tax based on if the property was received at the seller's location, the rate would be based on the seller's location. If the property was received at the location of the buyer, the tax is based on the buyer's location. So if I had a store location, I sold my customer some goods. They came into my office and purchased those goods, and that sale was consummated on my property. I would use the gross receipts tax based on the location of that sale. If I delivered that property to my customer's location, then I would collect gross receipts tax based on the location of where I delivered it to. So as I mentioned before, the rules for sourcing make a distinction between tangible personal property versus services. And services are a little bit more complex, and I think this is where this is where, in my opinion, I think we made it a little bit more complicated. And I hope there's an opportunity at some point to sort of simplify it a little bit with the legislature. But suffice to say, at this point, New Mexico within the services category, highlights general services, in-person services, professional services, construction services, and construction-related services. And so, you know, with those terms, your head's probably spinning. But, you know, for general services and in-person services, the tax is collected based on where the product of the service is delivered. Okay. For sales of professional services, the tax is collected based on the seller's office location. And we'll define what those are a little bit in a little bit more detail. But for construction services and construction-related services, the tax is based on where the construction project is located. So when we talk about professional services as a distinction between in-person services, professional services are services other than those in-person services that require an advanced degree or a license. And typically we think of professional services as being attorneys, accountants, and architectural and engineering firms. And as I mentioned before, professional services would report professional services firms, or people who are providing professional services, would report based on the location of where the services are performed, which generally speaking is their office location. In-person services are, and we provide examples, are typically healthcare workers, mental health workers, athletic trainers, physical therapists, barbers, cosmetologists, and home health services. Those services are sourced to where the service is delivered. So what does this mean? For sellers, the sourcing rules have become much more complex. And I think, and I draw a distinction between your larger sellers who have the capability and the sort of the wherewithal, the infrastructure to make these determinations because they have software that's fully capable of assisting and helping make making these determinations. But the real impact is going to be on the smaller taxpayers, the mom and pops, who don't have the sophisticated software to determine whether, you know, where the location is of their sellers. And they would probably, in likelihood, and we're seeing it with some of our clients, incorporating a manual process to determine what, you know, where, you know, what rate to use and how to calculate it and things of this nature. And so I think, you know, your smaller taxpayers, your mom and pops and you know, those kinds of folks are going to be impacted by this until this gets straightened out a little bit. I use the term it's likely more modifications will follow. I probably should say that I'm more hopeful that more modifications will follow, that, you know, that the legislature will take a look at this and sort of streamline it a little bit and make it a little bit less complex. I think particularly on the services side that, you know, you know, for folks who don't deal with this every day, I think it can be a little bit overwhelming and probably a little bit burdensome. So, you know, it's my hope that, you know, in the near future, that future legislative sessions will, you know, make some appropriate changes to kind of simplify this a little bit. For buyers, the compensating tax now applies to services. And so that's a significant change. And that's something that, you know, business buyers of property and services need to be aware of. And then finally, the compensating tax rate is now the same as the gross receipts tax rate. And so it used to be a little bit of there used to be a little bit of a play, as I mentioned before, where, you know, if you didn't pay the gross receipts tax, then at least you get like a 2 or 3% benefit by paying the compensating tax. That is no longer in effect because the compensating tax rate is now the same as the gross receipts tax rate. So let's talk a little bit about the changes in the manufacturing equipment and consumables. I think this is going to be a real helpful to manufacturers. I think this is going to be really helpful to folks like AED and others who are helping recruit manufacturers to New Mexico, because I think it helps put New Mexico on a much more even playing field than we were. And I'll explain a little bit of why that is. So in our most recent legislative session, the legislature passed House Bill 278, and it does two things that are important. First, it expands the manufacturing gross receipts tax deduction to include manufacturing services. So the important thing here is that if you're a manufacturer, you were able to purchase consumables tax-free, and those consumables that are consumed in the manufacturing process, they don't necessarily go into the product that's being manufactured. They get consumed as part of the manufacturing process. New Mexico allows manufacturers to purchase those kinds of consumables tax-free, which is very helpful. Consumables includes fuel, electricity, water. It includes a lot of items that other states don't allow for, and so I think that's helpful for recruiting manufacturers to New Mexico. That was already in place. The change there is the fact that New Mexico now acknowledges or includes manufacturing services. So if you're a contract manufacturer, you can buy that. What this change does is it allows you as a contract manufacturer to purchase consumables tax-free as well. And what I think is most significant as part of this this statute change is the fact that repair parts and spares are included in the consumable definition. Before, repair parts and spares were specifically excluded, and that language was struck, and that language no longer exists. So I think that piece really helps New Mexico step up and be more competitive with some of the surrounding states. And then I think the one thing I would note is the fact that if you're a manufacturer, you have to employ personnel to perform the production tasks. So these changes, as a result of these changes, this would likely exclude operations that are fully automated. And so that's one thing to keep in mind when if you're a manufacturer and you're looking to take advantage of this. So the second change, I think, in this statute, which I think is even more significant, is the fact that manufacturers and manufacturing service providers are now able to purchase or lease qualified manufacturing equipment tax-free. I think this piece is really significant. Prior to this change, If you were a manufacturer in New Mexico, the purchase of that equipment, unless you had an industrial revenue bond, the purchase of that equipment was taxable. Now, you could get a benefit on the back end if you qualified for an investment tax credit. The problem with the investment tax credit was that you had to pay the tax, you had to purchase the equipment and pay the tax up front, and then file for the credit later. The second problem with the investment tax credit, and still is the fact that well, the second problem with the investment tax credit, this problem has been fixed since then, is that the credit that the gross receipts tax that you paid to your vendor as a manufacturer would have been higher than the credit that you got on your investment tax credit. So for example, if you were purchasing from a New Mexico vendor and they charged you 7 or 8% gross receipts tax on the value of that manufacturing equipment, and you subsequently qualified for an investment tax credit at some point, your investment credit was only 5 1/8%. So you still had almost 3% difference there that you wouldn't have been able to recoup, excuse me. The other problems, I think, or the other issues that I've had with the investment tax credit is that in some cases the credit may not be able to be fully utilized. So the credit applies to your CRS taxes. If you're a manufacturer, you're more than likely selling for resale, so you don't necessarily have gross receipts tax obligations. You may, but it may be very small, or you may be selling to customers out of manufacturing and selling to customers out of state, whereas you wouldn't have any taxable gross receipts. And so the only significant obligation that you would have is your state withholding for your employees. And so, if you had a significant investment tax credit, it could take a significant period of time in order to utilize that credit. And then finally, the other issue that I've always had with the investment tax credit is that it was tied to an increase in FTEs. So if you were making significant investment if you were making significant investment in adding equipment, but you didn't add employees, you could not avail yourself of the investment tax credit. So I think the fact now that a manufacturer can purchase or lease, which is really incredible, or lease qualified manufacturing equipment tax-free, I think is really a benefit to New Mexico manufacturers. And I think it not only puts us on an equal playing field, but I think it puts us even ahead of a number of states, because in most states, manufacturing equipment is exempt from sales tax. The issue in most states are that some states don't allow you to purchase consumables, and some states have a very strict definition of what's manufacturing equipment. And then finally, very few states that I know of, or I should say, there are a number of states that I know of that don't allow an exemption for the leasing of manufacturing equipment. So I think this is very helpful to manufacturers in New Mexico. In order to qualify, the buyer's got an issue, the seller an NTTC. And the one other thing that I've noticed is that computer hardware and software that's used directly in the manufacturing process, that's going to qualify as well. It does not include motor vehicles that must be registered for them with the motor vehicle department, but again, and nor can it be used if you use an NTTC to purchase tax-free this qualified manufacturing equipment, you can't then go back and claim the investment credit for the same equipment. So that seems logical, but I think this makes manufacturers, or puts manufacturers on a pretty good footing as they are compared to other states manufacturing laws. Danielle mentioned before, this law becomes effective January 1st, 2022. And so I think there was a delay because I think the tax department wanted to, I think the tax department pushed out, asked that the effective date be pushed out because there were some things that they wanted to work through. But again, I think this is going to be a very important piece of legislation. So just briefly, in terms of what manufacturing is, New Mexico broadly defines manufacturing as combining processing components or materials to increase their value, but they do not include construction, farming, electric power generation, processing of natural resources, or the processing of meals for immediate consumption. It's important. That's important because it used to be that the preparation of meals used to be included in the definition of manufacturing. So that's interesting. In manufacturing services, same definition. It's really the service of combining or processing components or materials owned by another. And so I don't know if I mentioned before, in terms of the manufacturers being able to purchase equipment or lease equipment tax-free, that also applies to a manufacturing service provider. So, this is, again, I can't stress enough how I think this is, how helpful I think this is to recruiting manufacturers or retaining manufacturers who are expanding from a capital standpoint. So finally, we'll talk a little bit about the TAP system. The TAP system is it's the Taxpayer Access Point System, which is the system that a taxpayer uses to pay their state taxes. So you can pay your gross receipts taxes, you can pay your compensating tax, your wage withholding tax, any non-wage withholding taxes, any of your tax programs. This is the system from an electronic standpoint that you use to pay. You can use to pay your taxes with. New Mexico went and did some modifications to their existing TAP system, and actually it was pretty significant modifications to it. And I think some of the things that we've heard early on were it's a little bit confusing. I think what New Mexico was trying to do was make this system a little bit more intuitive, and so I think taxpayers are going to have to I think it's going to have to shake out a little bit, so where taxpayers are going to have to get used to this new system and the way the system kind of breaks out the different tax programs. Danielle alluded to it before, is that if you were familiar with the old system, and you can sort of visualize the old form, you paid your, and if you were paying your gross receipts, compensating tax, and state withholding, you were paying it all on one form, okay? And what the system does is it really, in effect, creates separate returns and payments for each tax program. So you have gross receipts tax is separate and distinct from compensating tax. Compensating tax is its own separate module. You have a wage withholding tax module. You have non-wage withholding, and you have other tax programs where they have their own module, and it allows you to pay and file returns for those specific tax programs. So I think that's the part that's going to take a little bit of getting used to for taxpayers who had gotten used to filing under the old system. Some of the more notable changes is that it creates a business tax profile for each business that you have registered. So if you're familiar with the old system and the old numbering system, you may recall that when you got registered for gross receipts tax purposes, they gave you what was called a CRS1 number. Okay, that number still exists and it stays the same. However, it's called the business tax identification number. Okay, under each BTIN, you'll have each tax program, and each tax program, and this is probably not the terminology they use, but it's the terminology I use. There's a sub account for each tax program underneath that BTIN number. And so you'll have a gross receipts tax number, you'll have a compensating tax number, you'll have a wage withholding tax number. And as I mentioned before, you'll also have each of those programs will also have their own distinct return, and you'll be able to apply payments to each of those tax programs, in addition to the other tax programs that exist. When you log on to the new TAP system and you notice that the system has changed, you won't automatically have all of those tax programs. You'll have the tax programs. A tax program will be created based on whether you have recently reported tax within those tax programs. So, for example, you might have taxpayers who have reported gross receipts, and they may have reported wage withholding, but they may not have reported compensating tax. So you might have two tax programs, and you'd have to add the compensating tax program if you wanted to pay compensating tax. So this system is set up to be fairly functional. So you're able to amend amend returns and request refunds within that system. If you were filing on a monthly, quarterly, or semi-annual basis, that frequency won't change. So you'll still be filing under that same filing frequency. And so my understanding is nothing has changed in that regard. You will be able to get correspondence. You can make correspondence. You will be able to get correspondence for each tax program. And so that piece is, taxpayers are going to have to get used to a little bit. But as my understanding is that most of the change that taxpayers are going to have to get used to is really presentation. And I think the department was admirable in trying to make this very intuitive. The question will be, how long it takes taxpayers to kind of get used to the new system, and whether there's any quirks in the new system. I don't think it's been around long enough for a lot of those things to shake out yet. So that concludes my presentation. Questions?
Yeah, Marcus, thank you so much. That was incredibly informative and really appreciate your time today. There are a couple of questions that have come in that I'd like to go ahead and put out there.
Sure.
Raymond Gonzalez has asked, I'm a small HVAC parts sales company of construction parts, which sells parts to construction companies out of state. How will this rule affect our part sales to customers, say, in Colorado or Arizona?
Great question. So this rule will really have no effect on your sales because the sales that you make to your customers in Colorado or your customers in Arizona will not be subject to gross receipts tax. Okay, so those sales are deductible from your gross receipts. You would report them as you normally would, but they're still deductible from gross receipts tax. Now, what you have to be worried about, or not, I shouldn't say worried, but what you have to be cognizant of is what your obligations are in Colorado and Arizona, because all states that have a sales tax now have a economic nexus regime, and so those states will have thresholds that if you derive a certain amount of revenue from their state, you will likely be required to collect sales tax or file a sales tax return.
Terrific, thank you. And we have another question here, and I'd also encourage anyone in the audience to go ahead and type in any questions you have in the Q&A section. This one is from Dora Dominguez regarding the manufacturing consumable tax credits. How would state TRD know whether a manufacturing process is fully automated process or not?
I think under audit. I don't know that there's anything that they would be able to make a determination if they were auditing the buyer and they determined that it was for a fully automated manufacturing process. I think that's really the way they would determine it. But I think the only way to really determine it is really under audit.
Okay, very, very good. And then I have a question for you. This is Deborah, as it relates to the investment tax credit.
Yep.
So in the past, we've said that the investment tax credit, and it used to equal what was the state's, compensating tax rate, or the compensating use tax applicable to that was at 5 1/8%. But now, from what I'm understanding, based on this presentation today, is that compensating tax rate will equal the GRT rate, but is that based on where the business is physically located, whatever that GRT rate is?
Yes.
Okay, terrific. And it looks like we have another question that has come in from Kenneth Vincent. I work from my home in Los Lunas. If I sell a photographic print to a customer in Raton and ship it directly to her, how do I calculate GRT? How would it be different if I deliver a digital file instead?
So your GRT calculation, it's a photo print, correct? Did I hear that right, Deb? Okay, so it's a photo print. Your GRT calculation would be based on where your customer is located. It would be no different if it was electronically delivered. Those two concepts would not change the rate of the tax that you would collect, because it's based on where your customer is located.
Okay, very good. Thank you. And one other question, I've had a question come up recently with a company. This is Deborah again, and it had to do with the cloud. So how are services that are delivered via the cloud, how is tax determined on those?
So the question, I think the underlying question is whether they are services as they relate to the statute versus generically what we think of as services. And so they may be considered the licensing of property rather than services, even though industry nomenclature would call them services. In other words, so for example, software can be delivered via tangible medium or electronically or via software as a service. From a New Mexico tax statute point of view, the software as a service is not considered a service, a quote unquote service. It's more akin to accessing property. So that's the distinction I'm trying to draw, is the fact that the property or the fact that the transaction listed as a service from a New Mexico tax standpoint, it may not in fact be viewed as a service.
Okay, terrific. Thank you. Another question here from Joey Kenny. Hi, Marcus. Can you talk a bit about how real estate transactions are taxed under this new structure? Also, do you agree that real estate agents would qualify as a professional service that requires a license?
Yeah, I think the real estate is going to be based on where the property is located. And so, I think there are a number of questions that are yet to be answered in terms of who gets professional service treatment. I don't know that. I know that TRD is fielding a lot of questions because I've sent a lot. I know that they are fielding a lot of questions with regards to, well, what about this? Are they a professional service? What are they, an in-person service? Well, how do you handle that? I think there are things yet to be ironed out, if you will. And so, I would punt a little bit about saying stay tuned, because what I do know is that just because there is a license per se, in and of itself doesn't necessarily mean that that's a professional service. But as it relates to real property, the service is going to be based on where that real property is located.
And would you have any recommendations as to how best people can stay attuned and be informed as some of these determinations are made out of tax and rev as we go forward?
Well, I think right now, they're doing a very good job. I will, in fairness to the department, they've got a pretty significant lift. And so I think one of the things that they are doing that I think is really good is that they are communicating via a lot of different channels and in a lot of different ways. So they have mailing lists and email address, they have mailing lists that you can access. They have, their website is full of some pretty decent information, but they also have links to some of their YouTube videos where they did a pretty decent job of kind of explaining from a high level some of these issues that we're talking about today. Now, again, when we get down to specifics, a lot of this information isn't going to be specific because there hasn't been enough time to kind of really ferret out every sort of enumeration or iteration or issue. But you know, they're doing a pretty good job, I think, of trying to get information out there as best they can. But I think right now it's stay tuned. The other thing I would be aware about is, you know, really what we're talking about is we're trying to get this thing accurate as best to our ability, but you know, we're not trying to cut it as fine as possible, but we're really trying to get it to the best of our ability. And so I think that there will be more information coming out. At least I hope there will be more information coming out as the department gets more questions and gets more experience in terms of you know, people's different situations. But I would probably start with the department's website, and I would probably start with, you know, with some of those specific links that they have within that website to some of those videos, because that's probably the only information that's out there.
Okay, terrific. Well, that's very, very helpful. So at this time, that appears to be all the questions that have come in. Again, just really informative. Appreciate your time today, Marcus. And Danielle, I don't know if you have any comments or anything at this time as well.
Just very grateful for all of this expertise on both of your accounts. Thanks everyone for tuning in and for sticking around, and we will make this available offline in the next few days. Thank you again.
Thank you.